It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. Thank you very much. Welcome back. I say thank you very much to whom? That's me on the announcement. Professor Plum, I still haven't changed that announcement, that opening, thing that says for 20 years we've been doing this. We're going to come up on 25 here.
Time does go by.
It sure does. Welcome to the show. This is Managing Your Financial Future, the podcast. And boy, we got a lot to get into today. And this is going to have to... Can we keep this discussion... I don't want to get too technical.
I understand you don't want to get too technical. Some of it is technical just in its very nature.
Yeah.
So I will try to not go too deep into the weeds.
Yeah, but it's such an important topic, and it's one that doesn't get addressed very often anywhere else besides right here on this podcast. And it's been a long time since we talked about this.
And what we're talking about is asset location, and it's something that we've talked about for decades, when we've been talking to clients. And in the past 5 years or more, just in the relatively recent past, I've started to see some discussions in the journalists and other areas talking about asset location.
Yeah, isn't that funny?
We talk about something long enough and the rest of the world starts picking up on it. It's kind of nice.
Well, it is. I always feel like we're pioneers in that department. Hey, we started the buckets thing like 30 years ago, and now, look how big that's become. So location of assets. Now, it sounds like a strange thing. It does sound like a technical term. And I guess it is. But, people have heard about asset allocation. And
yes.
I think people tend to think that asset allocation may be the same thing as location.
Just without 2 letters. But no, asset allocation
Let's
is important.
Go through the differences
I am not
between
going
these
to
two.
downplay the importance of asset allocation. I mean, part of the whole idea behind Bucket's strategy is allocating your assets appropriately to cover the needs that they're dealing with. Short-term needs, short-term assets, long-term needs, long-term assets. I mean, asset allocation is at the bottom, is the basic premise of what we're talking about from a bucket strategy. Asset location is more of, now that you know what types of assets you should have X amount of dollars, X percent of your portfolio in safer types of investments, X amount in fixed income, X amount in growth, real estate, whatever the case may be. You've identified the type of investment, but now you're going to identify, where should I hold that investment? And you have 3 basic different areas of holding an investment. You can hold it personally.
As in just in your
name, your trust name, but your name. So there's no tax sheltering. Whatever that asset earns in any given year will be taxable in that given year, whether you spend it or don't spend it.
Let's give a concrete example for people that may not be able to follow this. So let's say
the simplest is a bank account.
Yeah.
So I put $50,000 in a bank account. Now, up until recently, you really didn't have to worry about the taxability of it because it wasn't earning anything.
Exactly.
But now bank accounts can actually earn. I know a lot of bank accounts, money savings accounts, especially online savings accounts. They're in the 4% range.
Yeah.
So you put $50,000 in. It's been in there for the entire year. You earned $2,000 in interest, assuming a 4% interest rate. And so it's whether you leave that money in the bank account and you show that your balance is now $52,000, or whether you take it out and spend it or whatever you do with it, you're going to be taxed. That $2,000 of earnings is going to go on your tax return for this year
as ordinary income,
as an interest. Interest is ordinary income. So it doesn't matter what you do or don't do with it, you're going to be taxed on it.
So that's one place you could, if you had $50,000, you could keep it personally or put it in a personal account, as you said.
That's one type of ownership.
Okay.
The other type of ownership is I have an IRA, and I happen to have $50,000 in my IRA, and I happen to use the exact same type of bank account that earns 4%, and it's in my IRA. Now that is tax deferred. So the fact that it earned $2,000 this year and I left the money in the account, I don't have to pay taxes on it. So the difference isn't the investment. The difference in the taxability is in where the account is held, where that investment is held. I'm holding one of them personally. I'll pay taxes on the earnings every year, regardless of what I do with it. I'm holding the same type of investment in my IRA. I don't have to pay any taxes on that IRA until I withdraw the money, not from that investment, but until I withdraw the money from the IRA, from the account. So the type of account dictates what the type of taxation is going to happen to you. And so the three broad categories are personal investing, which is taxed when when the investment result occurs, a traditional tax-deferred IRA or traditional 401k, 403b, 457, simple IRA, SEP
all
IRA,
of those.
All the different traditional type of retirement accounts where there's no taxation at the investment level or the account level until I take money out of the account. And when the money comes out of the account, regardless of how it was created, whether it was capital gains, dividends, interest, return of principal, whatever the case may be, that distribution will be taxable when I take the money out. And the third type is the Roth IRA. The Roth IRA is tax deferred as well. Well, no, Rick, Roth IRAs are tax free. They start off as tax deferred until you reach the appropriate time horizon and age. Mm-hmm. And then you can start taking distributions from that account. So while they act very similar during the accumulation phase as a traditional IRA, when the money comes out of a Roth IRA, assuming we live up to the rules, it's tax-free. So we've got currently taxable, tax-deductible but future taxable, not tax-deductible contribution but tax-free in the future, hopefully.
So it's what it boils down to is personal
Roth,
or
and we're going to use Roth as a category. Roth 401k, Roth 457, Roth TS, 403b,
yes.
Roth IRA, and we're going to use traditional as IRA for the traditional tax deferred. So you've got these three different areas that you can own these investments. And the question then becomes, okay, I've identified my allocation. I should have some money in safety, some money in growth, some money in this, some money in that. Where should I actually own those assets? Should I own them in my personal name? Should I own them in my IRA? Should I own them in my Roth IRA? And like every other question in financial planning, the answer,
I get two words.
it depends.
Right.
It depends on your age and what you're trying to accomplish and part of it is where do you have the money to begin with? I mean, a lot of people end up having all their assets in their IRAs because that's where the money is. They don't have any personal accounts. They didn't ever, unfortunately, have the ability or opportunity to create Roth accounts, at least up until now. So now we've got, sometimes it's all going to be in your traditional because just like Willie said,
because
that's
there.
where the money is.
Yeah, exactly.
But if you have choices, when you're younger, it may be one way. When you're older, it may be a different way. When you're younger, in many cases, you're going to be all growth anyway. So you're going to have, if you have all three types of ownership, your growth accounts are going to be in your personal money, in your IRA money, and in your Roth money.
So when you're younger, let's say you've got a 401k, which many people do, and so that's kind of your quote unquote IRA money. That's your tax deferred
money.
We'll put it in that category. It's not an IRA, it's 401k. But many people do that, and that's one place. Now, if they have other places to save, maybe they look at the Roth option or maybe they look at the personal option.
And I'll step back and say, for most people when they're younger, they're going to be growth oriented, but they probably will still have an emergency fund. Now,
short-term stuff.
If you wanted to play rules of thumb, in this game, which don't always work. When you're in retirement, the rule of thumb, and again, this is a very loose rule of thumb, is assets that create ordinary taxable income, interest, non-qualified dividends, different types of passive income. If it's ordinary income, you might as well have that in your tax-deferred IRA type of accounts because when it comes out, it's ordinary income anyway. And assets that are growth-oriented with long-term capital gains, qualified dividends, things of that nature, which are taxed at a lower tax bracket, ultimately it could potentially receive a step-up in basis. The default would be to first look and have that in your personal
if
account.
possible.
But it doesn't always work this way. The Roth is the wild card because we can go both ways on that one. Now, when you're younger, I said most everything is going to be for growth, but your your emergency fund, which does create ordinary income. The interest that an emergency fund earns is ordinary interest. Well, my little rule of thumb earlier said put that in your IRA. Well, that doesn't work because if you're younger, you might need access to that emergency fund.
You don't want it. You don't want
the term emergency fund.
Tax, exactly.
And you can't get it out of the IRA without penalties.
Yeah.
And so even though it creates ordinary income, emergency funds are held personally for the most part.
Now, as we go through this, if people are following this, and I hope you are, this shows the importance of asset location and why we're talking about it. Because ultimately, I guess it comes down to how do you get the most bang for your buck in many cases, from a tax standpoint, from a current tax deduction standpoint, all of that stuff.
Right. Asset allocation is looking at things from the investment standpoint. Asset location is looking at the taxability of that investment and how to manage the taxes that we are ultimately going to have to pay, or hopefully that we can manage down a little bit and not have to pay as much. And so a lot of it has to do with where are we going to get the money, and understanding taxes is a key component. And that's why at the beginning of this, we talked about trying not to get too technical, trying not to go too far into the weeds. But unfortunately, we're going to be talking about taxes, and there are different tax treatments to different types of income. There are different tax treatments to different accounts and distributions. And you have to understand the tax treatment of the account, the taxability of the investment, the age of the individual, the tax bracket of the individual, and what other income that individual has to be able to understand what is this going to do to them, or hurt them if you take money out of these different areas. We saw this happen where a lot of people had growth in their personal accounts in 2020, 2021, 2022, mostly 2021. And those were very big years in growth. And a lot of things happened, especially at the mutual fund level, where there was a lot of what we call turnover, a lot of buying and selling of those growth assets that created a lot of taxable event, a lot of taxation in a personal account, even though we didn't take any money out of the account. And all of a sudden we're doing our taxes at the end of the year, and we've got these huge capital gains compared to what we normally get and have to put in our tax return. That's one problem with putting your personal money in growth, because it's variable. And sometimes you can't always predict what the market's going to do, good or bad. So in 2020 and 2021, we had big tax years. And then in 2022, we had basically no tax year from a personal account because it didn't earn anything. They went down in value.
Yes, we're talking about stocks.
The growth
equities,
accounts.
Yes, the growth.
And there is no income averaging anymore. I mean, every once in a while I'll have somebody come up, well, can't we do 10-year income averaging? 5-year? No.
Nope.
Not anymore. But so understanding what your account can do to you. IRAs are simple because we don't pay any income tax on it until we take money out. Then when we take it out, it's taxable, and hopefully we're old enough that we don't have to pay a penalty. But now it's a matter of, let's take a look at your plan. Let's take a look at where or how much income you're going to draw from your portfolio, how much cash flow you're going to be taking out of your portfolio. And if you take it all out of the IRA, what is that going to do to your tax bracket?
Well, that's going to jump it up depending on how much you have.
But unfortunately, this is where we're going to get back into the weeds again, because that distribution from the IRA can affect other things, like the taxability of your Social Security.
Yes.
Like the size of the Medicare premium you may or may not have to pay. So you have to look at it and say, well, we have defaults, we have rules of thumb. We're going to look to maybe take our distribution from our IRAs. For most people, that's where the money is anyway. But we start with looking at taking the money out of the IRA, and let's say we're going to take $50,000 a year out to supplement our Social Security and other things. Is that the best thing to do? Should we be taking 50 out? Because if we take 50,000 out, then all of the Social Security, 85% of the Social Security is going to be taxable. So I'm going to be in a fairly high tax bracket. Well, what if I back off on the IRA a little bit and use the Roth for some of the income? Now, the default for Roth has typically been let it grow for as long as possible. Let it, especially for a married couple, leave it for the survivor. But that's the default. But then it's a matter of, let's build this back into the plan. Should we maybe blend the cash flow, take some of, maybe only take 25 from the IRA and take 25 cash flow from the Roth IRA. Roth IRA isn't taxable, and it does not affect the taxes on your Social Security.
Assuming you've done the Roth correctly and followed the rules.
Assuming it's 5 years and you're 59 and a half. Whereas we're only taking 25,000 from the traditional IRA. I'm still getting my 50,000 of cash flow, but I've only got 25,000 of taxable, and now almost none of my Social Security is taxable.
Let me, and this is a great
try to make
point.
this easy to understand.
Let me back this up and get people to visualize this. So over the years, I've been saving my money in either Roth, let's just say Roth, IRA we'll call it, or I've got it personally. Okay, so those are three different boxes that I've been shoving my money into all these years. Okay, so when it comes time to retirement, I've got, let's say now, I've got 3 boxes of money that I can take out and use for whatever purposes I want to use them for. Okay,
Right.
One's a Roth, it's labeled Roth. One box is labeled IRA, let's call it, and one box is labeled personal. So now I need a certain amount of money to live off of.
I need to take a distribution.
I have to take a distribution. So I'm looking and I say, well, I need, 50 grand. I don't know what the number is. Well, so do I take it all out? Maybe I'll take it all out of my Roth. And you say, well, what are the consequences of doing that? Well, maybe none now, but you're depleting the Roth. Well, what if I take it all out of my IRA, as you just said some people would do?
Painfully taxable.
It could be. Well, personal, maybe I blend some of these.
Right.
So the whole point of asset location, if I'm explaining this correctly, Professor Plum, is you've been over the years locating different assets in one of these 3 different boxes, so that when it comes time to take them out, you have options to potentially minimize the amount of taxes you have to pay over the years.
Right, that's the idea. So let's just make up we have calculated the buckets, and you need to have $300,000 in bucket number 1. I'm just making numbers up here.
Oh, okay, all right.
And so should you put all 300,000 of bucket number 1 in your IRA? Should you keep all 300,000 of bucket number 1 in your personal account? Should you have 300,000 of your account of your portfolio in your Roth IRA in bucket number 1? Most likely, you're going to want to do something other than just put it all in one.
Yeah.
So maybe you put half of it in personal and half of it in the IRA, leave the Roth IRA to grow. Because the idea of, if I put $300,000 in which is my bucket number 1, in my personal account, and I withdraw, call it $50,000 a year. I'm just making numbers up. I take $50,000 out and I spend it. How much do I have to pay? What's my taxable event at that point?
Are you asking me?
Yeah, I'm asking
if you take it out of the IRA?
No, if I take it out of my personal account.
Oh, personal. Well, it's there. There's a tax
I earned 4%.
consideration.
I earned 4% interest on my $300,000.
Yeah, so you're going to be taxed on whatever the earnings are.
So I'm taking $50,000 of cash flow, but my taxable events are only going to be about $11,000. Give or take. $12,000 if I had it in there for a whole year, but it's not in there for the whole year. So
okay, so that's if I took it out of the personal account.
Now I got $11,000. So I got my Social Security, I've got my $50,000 of cash flow, and I don't owe any taxes because the $11,000 isn't enough to throw any of my Social Security into the taxable column, and the $11,000 of interest isn't enough to get over my standard deduction, and I don't have to pay any taxes.
So you're still in the quote-unquote 0% tax
I'm in the
bracket.
tax-free zone at the moment.
Are you married? Is that the deal?
Well, even single, the standard deduction is higher than that.
You're still under, yeah.
Yeah. So, but I can be very tax efficient, at least for a little while, until I get to age 73 when my required minimum distribution kicks in, and now I got to start pulling money out of the IRA. And I went from paying no taxes, and now I got $50,000 coming out of the IRA on top of the Social Security. Now $50,000 is taxable from the IRA, and 85% of my Social Security is taxable, and I'm paying a bunch of taxes for the rest of my life.
It's a mess when it can be a mess when it gets to required minimum distribution age. Because if you still got a ton of money in that IRA box because you've been leaving it alone because you didn't want to be taxed, you will be required to take it out at age 73 or
73
5.
now. Well, ultimately in 9 more years, it'll be 75. But
right.
And these are the complexities that we talked about earlier that we were trying to figure out a way not to get too complex. When you're talking about asset location, a lot of it has to do with understanding your taxes that we talked about earlier. But creating an investment or a strategy, a cash flow strategy that looks at taxes has to look at your ultimate required minimum distribution. Now, there are times where we actually want to accelerate income in the early years because maybe you're still in the 12% tax bracket, but only one of the spouses is taking their Social Security. And no matter what you do, that spouse's Social Security is going to be at 85%.
85% of
of the Social Security will be taxable. But now you still have another 20, 30, 40,000 of room, even though you took the money out of the IRA, to stay in the 12% bracket. But now you're back in a true 12% bracket because the taxation on the Social Security has already happened. So maybe we want to increase the IRA distribution by doing Roth conversions for a little while, so that by the time that the second person gets to Social Security, which is usually the person delaying is usually the higher wage earner, they get to their Social Security, and now we have to worry about the required minimum distribution. We have to worry about everything else. Wouldn't it be nice to have moved and used the true 12% bracket over to get things over to the Roth IRA?
So in other words,
rather than taking it out and paying 12% plus another, another tax, 12% on 85 cents of every Social Security dollar.
So in other words, taking money out of that IRA box and then transferring it back into the Roth box. Yes, it's taxable because anything coming out of that IRA box.
But it might be a lower tax than what it's going to be in the future.
Maybe it's 12. Maybe it's even less than that, depending on what you're living.
And by the time you get to 73, you've moved enough over that the RMD distribution from your traditional accounts has been lowered to where it's not affecting your Social Security going forward.
So this is a brilliant point. So would you say, as a general rule of thumb, that by the time you reach required minimum distribution age, having as little in that IRA account box, whatever you want to call it, is as possible is better?
Well, as little, that's kind of, because it doesn't have to be zero. I mean, because let's say you've got
zero, but
even with $250,000.
The lower, the better?
No, because even with $250,000, your required minimum distribution may only be 10 grand,
Yeah.
11, 12 grand. That may by itself be not enough to trigger anything else. So getting it as small as possible isn't the goal. Getting the required minimum distribution down below a certain point so that it doesn't, if possible, that doesn't affect your Social Security, and you can maybe be a little less or more tax efficient at that point, is a goal.
That's really where I was going. You said it better than I did. But lowering it
to it's complex.
Of course it's complex. How many people's heads are spinning right now?
And we haven't even talked about how the taxability of Social Security works. And yes,
we'll cover that on another one.
Well, I do want to say Social Security, the taxability of Social Security is about what other income is on the tax return. Roth distributions, qualified Roth distributions, at least 5 years, over 15 and a half, do not show up on the tax return. So we're not talking about Roth distributions in that sense. IRA, pension, interest, dividends, all capital gains, those are all income pieces that are on the IRA, and they affect the taxability of Social Security. Age has nothing to do with the taxability of Social Security. Unfortunately, that is a very big miscommunication, misnomer, whatever you want to call it. Misconception. That was the word I was struggling for. Sorry.
That's why I'm here.
I understand a lot of people get to age 70, and say, well, I'm 70 now. I don't have to worry about the taxation of my Social Security. Age has nothing to do with the taxability of Social Security. It's all driven by what other income you have that shows up on the tax return.
And that's why people often get surprised, because they've never been taxed on their Social Security payments. They reach RMD age, whatever their age happens to be, and now they're taking money out of their IRA that affects the taxation of their Social Security, and all of a sudden they're paying a lot more in taxes than they even planned to.
Right. Two other areas where asset location has a lot to do with what you're trying to accomplish. Retire early, before 65. You don't have health insurance. And but you want to have $80,000, $100,000 of income. Well, where are you going to get that money from? Your IRA? Well, that shows us with income. Now you got to pay full boat for your health insurance. You can't go to one of the exchanges and get the ACA subsidies.
Maybe you got Roth.
Maybe you have Roth. Maybe you have personal account.
Mm-hmm.
And so that's where, again, we break the rules, and say, okay, well, maybe you keep the money in, you've got $1 million in your bucket number one, you're taking 100,000 out. You retired at 50 or 55. You're taking 100,000 out. Well, that interest on that doesn't earn enough to push you out of the good subsidies for your health insurance until you get to 65,
right,
when you can get on Medicare. So understanding asset location for early retirement when health insurance is an issue. It's not an issue for everybody. Some people have health insurance through their employment even when they retire, but for a lot of people, one of the reasons to continue working until 65 is to keep health insurance. Got to have it.
I know many people that are doing that.
The other area where asset location is a big driving force, not just the taxability of Social Security, which is a huge driving force. It's the income-related monthly adjustment amount, IRMA, for the people on the upper income scale, as far as 200,000 above married couple, they have to worry about how much they're going to be end up paying for Medicare, their Medicare Part B and D and C for that matter premiums.
Mm-hmm.
And if you go over certain thresholds, which is a moving target, every year it goes up a little bit so far, it gets expensive on Medicare premiums. Medicare premiums $170 a month right now for the average person, but it could be as much as almost $550, $600, something like that a month if your income's too high. And what catches people by surprise is they start taking their RMDs. They start taking, they sell an asset and they create a large capital
vacation
gain.
Home or something.
Yeah, and all of a sudden, boom, they've got this income on their tax return that pushed them over the threshold, and now they're in the pain, the Irma pain.
The Irma pain. Well, okay, so, we're talking about asset location here.
Asset location matters.
It does. So when should people be thinking about this? Should they be thinking about this during their growth time of their life, when they're in their 30s, 40s, 50s, as they're building up a nest
when
egg?
You're trying to make the decision of, do I save into my traditional 401k or my Roth 401k? All of it's about what is the benefit of saving today and what is the cost of doing it that way tomorrow. I get a tax deduction today, but what is the taxable event when I take the money out? I don't get a tax deduction if I do a Roth, but what would it have been? What am I saving in the future?
Mm-hmm.
And so understanding what the potential tax hit is going to be when you take the money out is part of that equation. Unfortunately, it's not a known because who knows how many times they're going to change the tax code between now and 4 years from now.
Well, and you don't generally know if you're more than 10 years away from retirement, how much you're even going to need at that point or how much you're going to have. So it's a hard thing to do.
Well, when I was 55, I had a pretty good idea of what it was going to need.
Yeah, but when you were 40, 45, it was really hard to figure.
Right.
So
when I was 40, 45, my figuring was I need more.
Yeah, it's always more.
And it's more than I can afford to save right now.
Well, exactly. So this is why it's important. So it's important to think about this during your growth years, which I would call up to retirement. But after retirement, you still need to have a handle on asset location because now when you take the money out of those boxes that I mentioned before in my example, which one do you take them out of? That's still asset location.
That is asset location. And many times it's not, you've done your bucket strategy, and you know how much money you have in the different types of accounts. And it just happens that your IRA fits perfectly in bucket 2 and your personal money fits perfectly in bucket 1 and your Roth fits perfectly in bucket 3. That may not be the best location for everything, though, from a tax standpoint. Maybe we should blend and have a little bit of the different buckets in the different accounts so that we can manage our expenses. The specific expense I'm talking about is the taxes that we pay. And managing that expense is what basically asset location comes down to. But again, it's complicated. There are lots of variables, lots of factors that affect different things.
Well, I think for the average person who is busy doing whatever it is they do during the course of the day, the carpenter, the architect, whoever who specializes in this stuff, it's very, very hard for them, for anybody outside of a financial advisor to really get this right and to understand this. I mean, maybe you could, but it's a lot of work.
Well, and this is just basically the final pieces of the puzzle coming together. That you start with figuring out your needs. You build in what incomes are going to be happening at what times, your Social Security, your pensions, if that have that thing. You create your bucket strategy. You know your investments. You've decided how much in each type of investment you should have. Then the final piece is, where do I own those investments? And then set it up on automatic and go enjoy your life.
Well, and that's the point of it. And even if you got a ton of income and you're still in a high bracket, so it's not.
There may still be things to do,
but there are things to do because maybe you've got heirs that you want to leave some of this to, and they could wind up losing some of this to taxation. I mean, there are just other things to think about.
The thing that that doesn't get thought about a lot is unfortunately survivor issues.
Yeah,
for a married couple, it's unlikely that both in the couple will go at the same time, and once one spouse passes away, the next year, the surviving spouse is going to file as a single individual, not as a married couple.
If they don't get married right away.
Maybe that's,
I don't want to get into that, but
okay, let's go there.
Let's assume that there's a grieving period, okay, by at least a couple years.
And they lose one of the Social Securities. Their income goes down.
Yes.
And the expense of taxes go up because while the bracket, the 10, 12, 22 and up brackets don't change, the amount of income we can have in each of those brackets, for the most part, gets cut in half.
Yeah.
And so you have a much higher expense from a taxable standpoint and less income. That affects a survivor quite a bit.
It does. And oftentimes when a spouse dies, your income needs don't get cut in half.
Well, they don't get cut in half. They may go down a little bit.
They go down a little,
especially depending on which spouse passes away.
But you could lose a good chunk of your income because of that, and your tax brackets get jumped down to the
your
single.
taxable event. Your taxes go up, so expenses go up. Income goes down. That's not good for anybody except for the government. They seem to enjoy that.
Well, what you need to do is talk to an advisor about this stuff. 800-644-1150 is the number at Lucia Capital Group. That's what it comes down to. And again, I mean, as important as these things are to, I was going to say to understand, you should have a basic understanding of how this works. But I think leaving this kind of work to an advisor, especially over a good number of years, because you need to plan for this stuff well ahead of time. It involves required minimum distribution planning. It requires
might be health insurance planning. It might be all kinds of things.
Exactly. So I would suggest that you talk to one of the Lucia Capital Group advisors, because people like Professor Plum, as complicated as this is, Professor Plum, certified financial planner professional, CFP type, you understand this and you enjoy it.
It is kind of a sickness, yes. I do.
We've said this many times.
I do have fun putting the puzzle together.
Well, yeah, and that's your area of expertise.
But
can I say that? Maybe I can't say that.
I don't like puzzles, but I like this puzzle.
Well, it's in many ways the same thing. There's a picture you want to.
Yeah, but I get tired of putting those puzzles together.
Well, this is more like a Tetris kind of thing. Yeah. Where you don't have to put it in a certain place. That's what a puzzle is. This can be manipulated.
I don't like being that exact, huh?
Yeah, exactly. 800-644-1150. Talk to any of the advisors at Lucia Capital Group. They're all overseen by this guy sitting here to my right, Professor Rick Plum. 800-644-1150. As I said, that's the number at Lucia Capital Group. You can also find us online, luciacap.com, luciacap.com. And find the blog posts, as I say, and the videos and all that stuff. You can reach us via luciacap.com as well. Send us an email. We don't have time now, but maybe on our next show we'll talk. You talked about Roths and all that stuff. We've had some questions. We did about a month ago. We did a program on Roth versus 401k.
Or Roth versus traditional.
Yeah. Which one should you do? Which really comes back to this whole asset location thing. I want to try to talk about that next week if we can, clear up some of the confusion about Roth IRAs and how they work. Because honestly, I think if you can get the money into a Roth, and sometimes it's too expensive, or sometimes that time.
Immediate tax deduction outweighs the future. Who knows what it's going to be benefit?
Yes, but when those were added about 25 some odd years ago, 30 almost now, whatever. It's
25.
Is it 25? It was
97,
98.
98 was the first year we could do them.
That's right. Okay. Yeah. Well, anyway, so 98, 25 years. They've added a real element of complexity, and yet a good type of complexity to financial planning. So we'll talk about that next week. My thanks to Professor Rick Plum. Oh, by the way, you can find us at iTunes, Spotify, kind of all over the place. This is great. New subscribers, let us know you're there. We would love to hear from you. Let us know if you have anything you want us to address. Go to luciacap.com and send us an email. For Professor Rick Plum, I'm your podcast host, Johnny Dean. Thanks for listening. Talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with, and security and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.